I'm sure you've heard a lot of recent social media buzz about the DSCR loan. Are they as good as they sound, or are they all hype? Now, in theory, they sound great because there's no income verification, and the banks will actually look at the rental potential of that particular property that you're interested in. So the result is you have all these finance gurus on TikTok and other social medias who are talking about how easy it is to buy a house with a DSCR loan, and about how it's this secret trick of the rich because you don't need any income to buy a property with this loan type. So the thing is, they get some things about the DSCR right, but they also get some things wrong, and we're gonna hopefully clear up some of that stuff in this video. The whole reason I'm making this video anyways is because one of my clients reached out to me the other day, and he basically called me up and said that him and his dad were trying to buy a property, didn't really have a ton to put down for a down payment, which is a big problem with most people that want to buy. He was telling me about how he's heard a ton about this DSCR loan and about how you don't need any income verification. Basically, he was repeating to me all of the hype things that I heard. Essentially, the narrative is you can buy a property with no income. So today we're going to be talking about what the DSCR loan is, who the DSCR loan is for, what's true, what's not. By the end of this video, hopefully you'll be at the point where if one of your clients reaches out to you and asks you about the DSCR loan, you'll be able to intelligently describe it to them and let them know if that's really a good fit for them or if they should either wait or go for a different product. If this is your first time here, I'm Frank Kritzman, team leader here on the Emerald Coast in Florida. Here on this channel, I'm giving the real estate agents the tools they need to succeed. I love coaching, I love making videos, so here I am. So what is a DSCR loan? A DSCR loan is a debt service coverage ratio loan, and it uses the debt service coverage ratio when looking at particular houses. To find the debt service coverage ratio of a particular property, all you do is divide the net operating income by the debt service. In a little bit more simplified terms, it's the rental income for that property divided by what the mortgage would be. So if the rent is $2,000 and the mortgage is also $2,000, you have a debt service coverage ratio of 1. If a property has a DSCR of 1.5, then that means that the rent is 1.5 times the mortgage. So say for example, the rent is $1,500 and the mortgage is $1,000, that would be a property with a DSCR of 1.5. The closer you get to a DSCR of 1 equates to a little bit higher risk for that particular lender, but we're going to circle back to that in a little bit. When you're trying to get approved for a DSCR loan, that lender is actually going to be looking at the debt service coverage ratio of that property instead of the particular finances of that individual borrower. So as long as the rent is covering the mortgage, then you're good, right? Well, not exactly. That's where things get a little bit tricky. The hard part is actually getting that debt service coverage ratio to an acceptable number. Thing is, DSCR loans come in all shapes and sizes and can vary a lot from lender to lender. For example, you can have some fixed rate DSCRs, some variable rates, 30-year, 40-year. Some lenders will also set requirements for the minimum debt service coverage ratio threshold that they're willing to cover. So you might have one lender that says that they'll only cover a debt service coverage ratio of 1.2, and another lender might say that it has to be 1.5 for them to cover it. And because of the higher levels of risk involved, typically the DSCR loans are going to carry a slightly higher interest rate than your standard conventional investment property loan would. So what does that all mean? That means it's usually going to require a much higher down payment to get a property cash flowing the same amount as it would with a conventional loan. Which leads us back to the original question of who is the DSCR loan really for? Because social media is telling us that anybody can get one because you can just buy a property without income. Bottom line is you don't have to have your income verified, but you do have to have some kind of income in order to get the down payment to get that DSCR loan into the correct ratios to be able to apply for that loan in the first place. Which means that the type of person who will most likely benefit from using a debt service coverage ratio loan is somebody who maybe they have multiple properties already. They already have 10 conventional loans out and the bank doesn't want to give them any more loans. The bank takes a look at that individual and says, based off of your personal finances, your DTI is way too high. We're not going to give you another conventional, but we can offer you this other product that actually looks at the income potential of that particular property, given the down payment is high enough. In summary, don't listen to the hype. It's not as easy as it sounds. It's not a secret hack. It is helpful for some people in certain situations, but it's not the right product for just anyone to go out and get a property because they don't have a lot of income. That would be misrepresenting who the DSCR loan really helps. If this video was helpful for you and you'd like to personally help fuel my dopamine addiction, please press like on the video, and one of the 40 times I check my analytics, I'll see that pop up and get a little smile.